Before we begin, here's how to earn continuing professional education credit for attending this session. Gain valuable insights by attending the podcast, then complete the assessment test to download your certificate. To do this, follow these simple steps. Click on the link in your description to access the session. Create a free account and attend the podcast. After the podcast, take the assessment test and download your certificate. It's easy, and it's free. We highly recommend checking out our subscription. Let's get started.
I like the vendor concentration part as well, because that's you're the first one who's talked to me about it. I see people talking about client concentration, like if significant revenue is coming from one client, maybe you have like 200 clients, but maybe 10% of it is coming from just a handful of clients, and that could be a problem. But vendor side, that's a very interesting perspective.
You see it
Very,
quite a
very
bit, especially in third-party manufacturing, and 3PLs,
Yeah.
contract manufacturing, things like that. And a lot of people don't think about it. But how are your contracts with that? Are they pretty tight? How are they long-term? I mean, what do you have for? Yeah, you got to look at things like that. And seasonality,
Interesting.
same thing. Revenue, customer
Yeah.
seasonality. I'm not just
Yeah.
talking about pools and summers. I'm talking
Yeah.
about, what about, I was the CFO of a couple of companies a while back, and they had offset seasonalities. One was a summer company, one was a winter company. So it was great for cash flow between the two,
Yeah.
and you're in consolidated reports.
Yep. And especially with a lot of accounting firms as well, because
Yeah.
usually it's the season time. The tax season time is when you actually have a lot of revenue coming in, and then for the
Yeah.
rest of the years, the rest of the months, you got to diversify, and you probably have something to get things going. But there is a lot of seasonality in a lot of firms. We continue to see that a lot. Everybody's been told to diversify so that they have consistent cash flows coming in, get into new lines of
Well, and even
businesses,
tax
and
firms,
vice versa.
they have three typical types of revenue. They have their tax, of course, and then A&A, audit and attestation. But then they also have like consulting, whether it be, hey,
Yep.
we're gonna
Advisory.
consult you advisory. Yeah, exactly. QuickBooks, or how to do different tax structures, things like
Correct.
that. So
Correct. Welcome everyone to another episode of Accounting M&A Insider. I'm your host Saul, and today's episode is one that every firm owner is thinking while they're selling or even just curious about their valuation. They need to hear this. And we're calling this one the truth behind the numbers. Because let's be honest, right? In M&A, it's not always about what your financials say. It's about what they really mean. And there is no better person to break this down than my guest today, Patrick McMillan, who's spent years digging into the financials and uncovering what's really behind the story they tell. Patrick, welcome to the show.
Saul, thank you. It's my pleasure. I'm really looking forward to the conversation today.
Absolutely. Now, let's start simple for all our listeners, right? So, what exactly is a quality earnings report, and how is it different from, say, a standard financial audit?
Yeah, so an audit, the financial audit will give you the what. What is a company doing that's in compliance with GAAP? Where a quality of earnings, or a QoE, will really help someone to understand the how they're doing that and why they're doing it. So it really helps frame the story. There again, this whole thing today is, hey, what's the truth? What's the story? The QoE will really help dictate what that story is, and help the consumer of the QoE, whether it's a potential buyer, excuse me, or even the firm itself. It'll help them to truly understand what's going on, what's happening, what's that true story behind it.
Interesting. That's such a key distinction. And yet, in my conversation with sellers, I find a lot of them, they don't even think about the quality of earnings or the QoE until the buyer's actually asking for it, by which point it's often late in the process, right? So in your experience, why do sellers actually overlook the importance of the quality of earnings report until it's too late?
Yeah, I think it's three things, Saul, and not in any particular order, but number one, it's a cost. And often the accounting or finance teams looked at as a cost or an expense and not really adding value. And they don't understand that. So the second thing is truly understanding what kind of value a QV can provide. And then the
Mm-hmm.
third thing is, oh, I don't need to do that until, as you mentioned, until I'm under LOI, until, it's too late. Now, I don't want to say don't do it, if you're already under LOI, it's like, well, it's too late. I don't want to do it. It's just better if you do it earlier. And I know that's one of the questions we're going to dig into a bit later is what's the right timing. With that
True.
said, I kind of want to take a minute and really break down. I'm going to join this question as well as our first one. What is a QV? And I want to break down the name, quality
Yeah.
of earnings. So quality, we can think of like food, for example.
Okay.
Hey, I just ate a great meal at an Indian restaurant, and that quality was high because they sourced it right, they cooked it very well, they really spent some time on it. It was high quality. Versus you go
Mm-hmm.
to McDonald's or a fast food restaurant, yeah, it feeds you, but the quality's not high. So quality can be high, medium, or low. And a quality of earnings, that quality is what are those earnings or EBITDA, proxy for cash flow, free cash flow, net income. I mean, there's various ways to look at earnings, but where are those earnings derived from? And that will really denote the quality of it.
Nice, nice. That makes perfect sense actually. So, and for all the sellers who are listening in right now, Patrick, what are the buyers really looking for in a quality of earnings report? What's the golden nugget that they're hoping to
Yeah,
uncover?
that depends upon the type of buyer. And so really the
Uh-huh.
big kind of high level things they're looking for is they want to look for something that's going to help them have confidence. When they're
Yeah.
acquiring a company, they're really buying an asset, something that's going to
Right.
produce cash flow. And so they really want to be able to understand what that is. They're looking for what are the adjustments to EBITDA, and whether
Right.
those adjustments are valid or not for that specific buyer. They want to look at the balance sheet. And a lot of people forget about there's another financial statement. There's more than just the income statement. There's the balance sheet. There's the statement of cash flows. So the buyers are really looking at those items and saying, okay, well, on the balance sheet, how are the assets utilized to create cash flow, to create earnings? And so they really are looking for that to be able to understand what that asset is. And I mean asset, the firm as a whole that they're acquiring.
I love it. I love it. And let's just move on to the next segment because I want to really talk about EBITDA because that's something. It's a term that's been thrown around
See my
in
shirt
every
here,
M&A
right?
conversation. It's kind of like it's thrown around in every M&A conversation as if it's like a gospel truth.
Yep.
But but like if you're being honest, it's also one of the most manipulated numbers in the room. All right,
It
Patrick.
is. It
So
absolutely is.
so
I'm the
why is
QoE
EBITDA
guy.
overhyped?
And I say that.
Yeah, yeah. So why is EBITDA so much overhyped in these transactions?
Well, because we as the world have hyped it up.
Mhm.
And I have a plaque here. It's actually a t-shirt and I have another t-shirt. So I have two of them, but it says warning may start talking about EBITDA. I wore that t-shirt when I spoke at this conference too. But why is it overhyped? It's because it's a generalized metric that can be used. It's an apples to apples comparison. You can look
Right.
at public companies, private companies, billion-dollar companies, or million-dollar companies. And you can do EBITDA adjustments, love them or hate them. You can look at an apples to apples comparison. It's interesting, Saul, because a lot of people think it's new. It's not. It's not new. I actually have, and I keep this on my desk, the book
Uh-huh.
Quality of Earnings by Thornton O'Glove. This book was published in the mid 80s. It's
Whoa.
been around for a very, very long time, but it's become more and more known because of there's less IPOs going on and more private equity, venture capital, strategic activity happening behind the scenes. And so that's why it's getting overhyped. Because when you buy a stock, you're typically looking at like PE, price to earnings ratio. But when you buy
Yes.
a private company, you're looking at, well, what multiple did you get? Or, what's the multiple of EBITDA or cash flow or revenue, and depending upon, the industry and everything. So is it overhyped? Yes. Should it be overhyped? Yes.
Yes.
What do I mean by that? You should learn about it. You should
Yeah.
understand it and
Yep.
then decide how you can utilize it. Whether you like it or not, you should learn about it and how you can utilize it.
Do you want to earn CPE credit? Take this course of MyCPE 1 to earn free credit. Click the link in the description to get started.
Well, during the conversation, you shared this book, Quality of Earnings, which has been written in the 80s. Whatever is mentioned in that book, does it still hold true in terms of everything that's mentioned in there?
Yes. So Thornton O'Gloff, he actually discusses more about it. He's got an interesting story. So I'm going to spare all the details, but he talks about valuating cash flow. He talks about looking at things such as, and I'm going to use the word that he doesn't use, but it's one that we commonly throw around today is DSO, days sales outstanding, for example.
Yes.
How quickly are you
Yeah.
collecting are you changing from AR and converting that to cash? He looks at things like that. And he talks
Nice.
about those. He talks about inventory turns. Those are things that a
Nice.
QV will really dive into and look at. It's not always just about the EBITDA. It's about the quality of what's happening in the company. If a
Yes.
manufacturing company buys a whole bunch of parts because they get them
Yep.
on sale, then those
Yep.
inventory turns will change. And that really changes. It doesn't change the earnings, but it definitely changes the cash flow of the company. And it really changes how quickly they're going to churn through that or not. And if you're looking at acquiring this company, then you should really get into that and understand it because that cash flow will become yours and will affect your pocket as well.
True that. True that. And whenever we're talking about EBITDA, there's always this word that we get into the add backs, right? That's a term
Yep.
that's used a lot in the EBITDA, and I'm seeing like sellers who are trying to add back everything from owner perks to, I don't know, their
Oh
Netflix
yeah.
subscription as well. so
Yep.
so like what are some most common add backs that sellers push, and like do buyers actually buy into them?
Yeah, I'm going to answer those kind of differently a little bit. So, what are some of the most common add backs? Well, number one,
Yeah.
and this is what Thornton talks about in the book quite a bit. There's really two types of add backs. There's non-operating, they don't
Right.
have anything to do with the normal operations of the business, and
Mm-hmm.
non-recurring. Maybe they do
Nice.
have to do with normal operations, but it's a one-time event or a
Mm-hmm.
once in a blue moon type thing. So some of the common ones are, and we're going to talk about non-operating first, okay? So
Right.
maybe TM&E, travel, meals, and entertainment. So maybe
Yes.
it's a company that, and you see this a lot, okay? So the
Mm-hmm.
owner or owners are using the company as a piggy bank. They're going to Hawaii, they're going to Florida, they're going to, France or wherever, and it's a company expense, and it really isn't. Now,
Mm-hmm.
I'm not a tax guy. I'm not going to tell you that they can or cannot or should not. That's a conversation for another day. But if it doesn't have anything to do with the business, then it's going to be added back, whether it's the sellers adding that back and me accepting it or trying to validate it, or me saying, hey, I'm looking at your travel and I see it. I actually saw this morning. I see a $25,000 trip. What is that? Oh, we took
Mm-hmm.
our whole family on a cruise. Okay, family. They didn't work in the business. They didn't do anything about revenue. There weren't any perks for the business. So that's a very, very typical add back. Another one is manager or owner salary. And that can
Yes.
be a positive or a negative add back. If they're
True.
paying themselves too much and it's
Mm-hmm.
not market standard or market rates, then that's going to
True.
be a positive add back because you have to be able to say, hey, you know what, you shouldn't be paying yourself $750,000. It's probably going to be more like, 200 or 250. So it's going to be, and the flip side is also true because
True.
maybe because of the entity structure, or again,
Yeah.
another conversation for another day, maybe there's not a manager slash president slash general manager or whatever salary on there. And we need to do a negative add back because you as the owner are going to pay a general manager. And so we got to make sure we put that on the income statement. We've got to burden that
True.
on
True.
there.
We
So
got a
yeah,
burden
there's a
that.
lot of those. Do buyers actually buy it? It really depends upon what's the buyer going to do with the company. And that's the thing I
Yep.
need to emphasize. When I'm doing quality of earnings, I'm making sure I'm having conversations with the buyer and seller. And a lot of times
Right.
it's done together. Hey, buyer, seller's talking about this that's going on in the company, and this is how they use the cash flow for it. What are you going to do about it? Is that going to be the same way? Is it going to be different? So I'm trying to make sure to kind of be that, I don't want to say mediator, because those are really good, solid conversations, but it's really helping them to understand, hey, buyer, this is why we're doing this adjustment. And hey, seller, this is why it's going to affect how much it's going to go into your pocket, whether it's positive or negative. That way, it's
Yeah.
just getting everything on the table and truly understanding that.
Wow. I love it. I love how you put that. And like for a person who has been in this industry for a long time, you have probably looked at a lot of financial statements and you've done a lot of
Hundreds
quality of
or
earnings.
yeah, thousands of financial statements. Yeah.
Thousands of them. So let me tap into your history. Any war stories that you can share where EBITDA looked fantastic until the quality
Ooh.
of earnings pulled the curtain back?
Yes, I can go into a lot of these, but one that sticks out of my head. I started working on a sell side quality of earnings a while back.
Uh-huh.
And let me kind of set the stage a little bit. And I'm going to round numbers, of course. So $40 million home care agency company. And
Nice.
they had a fractional CFO firm, not mine, but another one. This is in a different state, not Utah. And when I do a quality of earnings, I also produce a statement of cash flows because that's very telling
Right.
for a lot of ways. And there was
Yes.
something that just flagged me in the statement of cash flows, like, this doesn't make sense. So I kept pushing and asking questions, asking questions. And after a couple of days of that, I found it. There's $1 million of fraud that happened. There were two owners. The first owner had stepped away for a little bit to take care of some other businesses and things, and the second owner had stripped out $1 million from the company, but had pushed it into the income statement. The fractional CFO firm asked second owner about this a little bit. Second owner kind of brushed it off a little bit, and so they just left it.
Yeah.
Well, so when I called the first owner and said, hey, I think you need to come back, we need to have a conversation about this, about what's going on, because this is really weird.
Yeah.
Well, long story short, Saul, it was fraudulent. They came to an agreement. Second owner is out now. First owner is back running the business. We paused the QV, but since then we had finished it because they'd gotten everything cleaned up, and so we've been able to get the company back operational and ready to sell. But that was just, it was frustrating for everybody involved. They fired
Yeah.
the fractional firm, hired another one. Yeah, it was a pretty crazy thing. And it was interesting, Saul, because I was able to find that in a few hours where the
Mm-hmm.
fractional CFO firm that they were using, they caught it, but they didn't push it enough. They just accepted it. And I'm not one to just accept things. I want to make sure that I truly can understand the story. Because if we're going to involve other people's money, they need to
Yep.
understand what they're investing into. And so that's why, not just from a QV perspective, but from a fractional CFO perspective as well, push until you truly understand what's happening.
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now.
Yep. Until you're not sure, until you're not confident, until you're not satisfied that, okay, this makes sense.
Exactly.
You
It's gotta
continue
make
pushing in.
sense. Yeah.
It gotta make sense. Gotta make sense because that's what it's about, right? It's the quality,
Yeah.
and it cannot happen just like that. All right, this is great.
Exactly.
So let's talk about the uh-oh moments in due diligence, right? So you already shared a war story, but what are some most common red flags that you encounter while you're reviewing a firm's financials?
Yeah. So this goes back to quality. So one of the high quality is if the cash flow matches the earnings
Hmm.
without much of a variance or without many adjustments. And so,
Yeah.
for example, a red flag. So when I'm doing a cash proof, and my tolerance is 2%. So if the cash flow, if the cash inflows from the bank match the inflows produced on the financial statements within a 2% variance and without hardly any adjustments, then that to me is green. But if I
Yeah.
have to go in and adjust, okay, well, they've gotten, 14 deposits from loans, 18 deposits from investors, oh, and their cousin Johnny, made a deposit, but because it was in the wrong account, had to move it back. Then you start creating a bunch of adjustments. And so the more adjustments you have, the lower it reduces the quality right there. So yeah,
Right.
cash flow matching. That's one of the things. Another thing, another red flag is the more, and I mentioned it, but the more adjustments you have to make to normalize the earnings, the lower the quality is. And that
Yeah.
becomes a red flag. I did a QV a while back where almost the entire earnings were produced by adjustments. And it
Whoa.
was not fun because it's like one of those, I mean, they're hard to validate, they're hard to prove. And it's like, okay, buyer, you're buying, and I'm just going to round numbers, $1 million, asset company, $1 million EBITDA company, but every single bit of that's from adjustments. How comfortable are you going to, what's the risk level of
Oh,
that? And that
very
right
high.
there is the key word, is how risky is that? If you're going to invest in a company, you're definitely going to reduce your risk as much as possible,
True that.
or
True that.
mitigate it at least.
Yeah. At least mitigate it. Yeah. Or manage it better, or however we
Manage
want
your
to put it.
risk. Exactly.
Yeah. So, and I know we've spoken about this certainly earlier in this conversation, but these tricky items like owner's compensation or legal settlements or those one-time income events that we spoke about, how do these get addressed in the quality of earnings report?
Yeah, and there again, like owner comp, it can be adjusted positive or negative. Legal settlements,
Yeah.
it really depends. I'll use another example for that one. So I was doing a QV on the firm one time, and legal settlements and management adjusted. In other words, the seller proposed, hey, all of these expenses are legal issues, but they were going on for like several years and there were
Oh.
different ones. And I'm
Mm.
like, okay, guys, I'm uncomfortable with this as an adjustment because you're obviously highly litigated, which
Yeah.
is not just an adjustment issue, but now it's a legal issue for the buyer.
It's
And so
yeah.
when I
Yeah.
disclose that to the buyer, I think that deal was killed, eventually. But that's
Yeah.
just, yeah. So, but if it's a legit one-time thing, hey,
Yeah.
you know what? Fired an employee, they litigated against us, we're working on it. Okay, I see those a lot, and that's okay because there again, we've got to make sure if those legal fees are hitting the income statement and they truly are one time, then yeah, I think that's a valid adjustment as long as we can validate it and prove it. But if it's something that, you know, but you also have a contingency liability.
Mm-hmm.
Hey, this may be, a $250,000 or a $2 million exposure. And so now we have to put a contingency liability on there and create an adjustment for that. So it can go a couple of different ways. It just really depends.
Yeah,
Um,
it does. It does.
One-time income. I was looking at one this morning where they were, I can't remember what they were selling actually. It was an accounting firm.
Hmm.
Oh, it was a construction revenue. And I can't remember why, because I just barely saw this. And I didn't dig into it yet, but it was construction revenue. I'm like, oh, that has nothing to do with their accounting part. And so that was, and you got to adjust out the income, but also you need associated cost, with that too. So yeah, I mean, you see a lot of stuff. And I'm there again, it's one of those things where for owners who are out there, and especially those who are listening, yes, try your best to have cleaner accounting. I'm not expecting you to have perfect accounting. I've never seen anybody have perfect accounting. Public companies don't have perfect accounting. Okay, they
Yeah.
pass audit. Audit doesn't mean you're perfect. It just means you're doing stuff that's in compliance with generally accepted accounting principles.
Principles.
Yeah.
Yes.
So
Yes.
there's
You're in that
yeah,
acceptable level. That's it.
an
You're just in an
acceptable
acceptable
level.
level.
Exactly.
Yeah.
I've seen partners at accounting firms argue about how to post something. That's how it goes. So there again, you got
Yeah.
to understand the story.
Yeah, absolutely. We gotta. And and I've seen buyers who get spooked by this, when they're looking at a business, they actually kind of get spooked when they look into the revenue and they see that there is seasonality in the revenue, or the revenue concentration for that matter. Like if one client is
Yeah.
making up more than, I don't know, 30% of the revenue. So
Yeah.
how do buyers really view these risks?
Revenue concentration risk is definitely something and a lot of that will depend upon whether you're a financial buyer or a strategic buyer as well.
Right.
But revenue concentrations, will absolutely affect how to look at a deal because, okay, going back to another one, all of their revenue came from six clients. There again, this is the same one, $40 million company, came from six clients. But the
Wow.
interesting thing was how those six clients are government-based clients and they're all
Ooh.
very solid and they're not
Yeah.
going anywhere. They're long-term contracts.
Yep.
As one of my CFO clients, one of my longest standing CFO clients, they have one line of revenue, $10 million company, they have one customer. But there again, it's a government contract and it's a 5-year contract that renews every year. So that's
Nice.
different than if you have a, e-commerce company, or okay, and I see this quite a bit, or if you have a uh, a nutraceutical and you're selling to grocery stores, but you only have five grocery stores, but one of them comprises of 30-40% of your revenue. We call it the hero product or the hero store.
Yeah.
Then that's
Yeah.
where your concentration becomes a risk because it's like, okay, well, what happens if you lose that contract? And it's the same thing, not just customer, but what about vendors?
Yes.
What if you're a or you have a contract manufacturer and they go out of business or
Yeah.
they raise prices?
Yeah.
Then it
Yeah.
becomes a vendor concentration issue. So yeah, so you got to look at and evaluate those types of risk, and you may not be able to quantify it, but if you can at least have the discussion and understand between buyer and seller, hey, how is that risk going to be managed? Then you can say, well, we can work on a deal together.
I like the vendor concentration part as well because that's you're the first one who's talked to me about it. I see people talking about client concentration, like if significant revenue is coming from one client, maybe you have like 200 clients, but maybe 10% of it is coming from just a handful of clients, and that could be a problem. But vendor side, that's a very
Yeah.
interesting perspective.
You see it
Very,
quite a
very
bit,
interesting.
especially in third-party manufacturing and 3PLs,
Yeah.
contract manufacturing, things like that. And a lot of people don't think about it, but how are your contracts
But
with that? Are they pretty tight? How are they long term? I mean, what do you have for, yeah, you got to look at things like that. And seasonality, same
interesting.
thing. Revenue, customer
Yeah.
seasonality. I'm not just
Yeah.
talking about pools and summers. I'm talking
Yeah.
about, what about, I was a CFO of a couple of companies a while back and they had offset seasonalities. One was a summer company, one was a winter company. So it was great for cash flow between the two when
Yeah.
you're in consolidated reports.
Yep. Yep. And especially with a lot of accounting firms as well, because
Yeah.
usually it's the season time. The tax season time is when you actually have a lot of revenue coming in, and then for the rest
Yep.
of the years, I mean the rest of the months, you got to diversify and you probably have something to get things going. But there is a lot of
Yeah.
seasonality in a lot of firms. We continue to see that a lot. Everybody's been told to diversify so that they have consistent cash flows coming in, get into new
Yeah.
lines
Well,
of
and even
businesses,
tax
and
firms,
vice
they
versa.
have they have three typical types of revenue. They have their tax, of course, and then A&A audit and attestation. But then they also have like consulting, whether it be, hey,
Yep,
we're gonna
advisory. Yeah,
consult you advisory. Yeah, exactly. QuickBooks or how to do different tax structures, things like
correct,
that. So
correct. That's true. That's true. So let's flip the narrative to the seller's perspective, right?
nice.
If I'm a farm owner and I'm thinking of selling in, say, 12 to 18 months, when should I start preparing for the quality of earnings report?
If you're thinking to sell in 12 to 18 months, you should start preparing 5 years ago.
Whoa.
So as a certified exit planning advisor, Saul, and this is something that even before I got my certification, I believe so deeply on. Exit
Hmm.
strategy is just good business strategy. You should,
Okay.
and our president of our firm of Amplio always
Hmm.
says you should always be ready to sell because you never know. Okay, there's the
Hmm.
5 Ds. I'm not going to remember all of them, but like, death, divorce, things like that. You should always be preparing to sell. You
Hmm.
should always be trying to get things firmed up and lined up. So, and a lot of people are thinking, okay, Patrick, you're probably talking about, well, let's revenue concentration, let's expand customers. Yeah, I'm talking about that, but let's go even deeper. Now, let's look at the balance sheet. Okay, let's look at how not just are your accounting policies, procedures, are your accrual based, but let's look at what capital do you have? What's your customer capital? Okay, how much can you actually reach out and expand on your customer and your services or products to them? Let's look at employee capital. Let's look at, do you have solid employee contracts? Are you incentivizing your employees to stay long term with you, even after a transaction?
Oh,
Let's look at
don't get me started on
IP,
that, man.
right?
That's
Intellectual
crazy.
property. How's your moat?
Yeah.
What are you doing to build your moat around what your offering is?
Yeah.
Those are things
Yeah.
that you need to prepare long years before sale. Now, it's notwithstanding, Saul, that someone calls me and they say, "Hey, Patrick, I'm under LOI. Can you do a QoE?" Of course I can. But the thing is, the longer timeline that you have, the more open options, the more opportunities you have. The longer you wait,
Nice.
the tighter those options get.
I like it. I like it. So what about the homework part? You mentioned you should have started 5 years back. So what about the homework part, right? What documents or data points should a seller have ready so they're not scrambling when the due diligence starts?
Yes, I'm going to give you two very easy ones, but very
All right.
time consuming. And sometimes
Okay.
you can get them done in a day, and sometimes you may have to do some digging. Okay. At
Mm-hmm.
least for the last 3 years, I want you to put into a data room, whether that's Google Drive, Dropbox, some kind of data room. I want you to have every single one of your bank statements in there for every single
Mm-hmm.
bank you have and have ever had over at least the last 3 years, because that's what I'm going to dig into for QV, as well as your payroll reports, whether
Nice.
that be from QuickBooks, Gusto, whatever it is that you're using, ADP. I want your payroll reports, and I want them in PDF and Excel for two
Nice.
reasons. Number one, Excel, because I can put those in my data book very easily.
Yep.
PDF, because they're harder to manipulate, and I want to be able to see
Yes.
that. So if you have both those, and those are the lowest hanging fruit, best, quickest things that you can at least get, because those are the first two things I'm going to ask for in a QV. And if you can send those to me the next day, I am running. I can get into this and I can get going real fast. But then
Nice.
aside from that, I want customer contracts, I want vendor contracts, I want employee agreements, I want lease agreements, I want all those things in there. And when I say lease agreements, I mean all the addendums as well. Don't give me a lease
Yes.
agreement that was signed 5 years ago that's been addendumed 3 times without giving me the addendums, because I'm going to see in your accounting what the updated amounts are, but I need something to back that up. I
True.
got to do lease
True.
accounting in there too, so give me the backup for it.
Yeah. In fact, leases are something that it's often overlooked. I have come across a story. In fact, this was something that was also highlighted in one of our PE webinars by one of the lawyers, uh, Sarah Sharp. She does a lot of deals. She handles the legal side of it. And she also mentioned that, you got to look into the leases, okay? You can't just ignore it. You got to really look into it. Last thing you want is you acquired a business that's been leased out, and now the new owner is like, oh, we need to relook into this because now you were earlier a firm, but now a private equity is acquiring it. That means they have more money. So I want more money for my lease. That could be a problem.
I got a
Right.
story, a quick story about that. One of our former consultants got a full-time job, FP&A job, and he's doing amazing. He made a ton of money. He's actually getting ready to acquire a firm right now. It's on hold because of the lease agreement.
Whoa.
The
Yeah.
lease may not be able to be transferred and or extended to a new buyer without killing the deal. And they're in deep, deep debt. And for 2 weeks now, Saul, they've been in negotiations for that. I'm waiting to start a QOV, but right now, he actually, a couple of days ago, he sent me an email and said, "Patrick, we're on hold because we're still trying to negotiate the lease agreement."
Oh man. Horror
Yeah,
stories, man. I hear that a lot, it's one of the most overlooked things, so thank you for pointing that out. And
absolutely.
and and I'm going to be asking you something which it's kind of controversial
I
in
love
my
controversial
opinion.
stuff.
So what's your take on sellers doing a preemptive quality of earnings report? Is it a wise move, or does it risk showing too many cards too early?
Absolutely wise, 100%. And I've done these multiple times where a company, and typically it's because they think they want to go sell. But the
Mm-hmm.
reason why you want to do a sell side QV is because
Mm-hmm.
number one, it helps you to take a look at your own company from a buyer's perspective. And
Right.
number two, it helps you prepare. There
Mm-hmm.
again, it's like, okay, well, getting all those documents in order, I'm going to ask for those on a sell side QV anyway. So it's
True.
kind of like a test run, but it also helps you to see, oh my gosh, I had,
Yeah.
so I don't know how many times I've heard this. Patrick, I had never looked at my financials from that perspective. Thank you.
Yes.
And it's one of
Yes.
those things, especially on a sell side QV. I'm going to tell you some advice. I'm going to give you ideas on what you can do better to
Yep.
at least manage the financials of the company. So highly, highly recommend it. We acquired a valuation firm. We made 3 acquisitions ourselves last year. And so we acquired a valuation firm. And they actually have
Nice.
a lot of clients who are doing an annual valuation
Whoa.
just
That's
so they can
nice.
see the progress.
Nice. I really like that. I really like that. You spoke about the buyer's perspective. And I just want to talk on that because not all buyers would look at the deal in the same way, right? So, I mean, I'll talk about private equity buyers and strategic buyers. So, how do both of them approach? In fact, do they really approach quality of earnings differently, or do all of them look at it the same way?
They do approach it differently. Private equity, they're going to look more about earnings and cash flow because they're a financial buyer. So private
Yeah.
equity, they're looking at, the EBITDA multiple, the cash flow. They're really, really, really going to scrutinize the add backs,
Yeah.
because they're really wanting to make sure that the asset that they're acquiring is going to, fit their model that
Yeah.
they're looking at. Net working capital is huge because they're a
Hmm.
financial buyer. It's all about the money. Okay. They really want
Yeah.
to make sure that they're pegging that net working capital. They're really going to look at, buying a company, their entry multiple. That's why EBITDA is so important. And then their exit multiple. How much are they going to flip
Yeah.
that company for? Now, versus a strategic buyer, kind of talking about some of the same things. Strategic, they're looking at EBITDA and cash flow, but they're looking more for synergies. I want to make sure it's going to
Yeah.
fit. Why are they buying it? Are they buying it for the book? Are they buying it for the employees? Are they buying it for the IP? So they're really
Yep.
wanting to look at that strategic fit.
Yep.
Where a PE is looking more at kind of the EBITDA multiple, a strategic buyer is looking more like, hey, let's look at the revenue margin, strategic premium. What can we do to really fit this in with our group of companies? They're not scrutinizing the ad back. So, I mean, they are, but they're not like digging so hard in
Digging so
certain
much.
detail.
Yeah.
They want to make sure it's going to be a good, almost like a culture fit in a
Yes.
sense.
Yeah.
They're looking more at product, looking more at customers, looking more at team, things
Yeah.
like that. And their relationship strategics, they're not looking for a 5 year, 10-year exit. They're looking for a long-term fit. And so they're
True.
going to look at, more of the strategic ideas behind. And
Yep.
there again, that's why at QV we're really dig into not just the numbers, but it digs into the story. Hey, let's
Yep.
talk about the accounting team. Hey, let's talk about key leaders. Hey, let's talk about
Yeah.
what they're actually doing in the company and how they're affecting revenue and earnings and everything. So that's
Nice.
kind of
I
the
like
big
that.
difference between private equity and strategic and how they're consuming a QV or looking at a company.
I like it. I like it. So, have you seen deals where a strong quality of earnings report has actually saved a transaction, or where a bad one actually killed it?
Oh yeah. Yeah, I've seen both quite a bit. I was talking with a client. I think he's on his fourth or fifth acquisition now, and we're
Nice.
doing the second or third QV for him. He actually, one of a potential client asked for a referral, so I sent them to Sean. Sean's the current client that we've done several for now. And Sean actually said on his last deal, he renegotiated. It wasn't a retrade, but it was a reprice. Retrade's, negative connotation. It was a reprice. because we had uncovered, I think it was like $800,000 of something that he didn't even think about, and
Whoa.
that was a direct impact to EBITDA. So it
Yeah.
changed cash flow, it changed everything. He was able to reprice that and
Yep.
still close a deal, but it definitely changed a lot of things. I've seen QVs kill a deal. And it's
Mm-hmm.
not my goal to kill. I know QV providers out there, it's their goal to try to kill the deal. That's not, my goal isn't to kill the deal. My goal is to make sure I get all the skeletons out of the closet and we want to dig into them. We want to look at them. We want to see how long they've been there, how old they are. I mean, we're really just trying to and open that up so everybody can understand what that skeleton is, where it came from, and what can you do with it. Now, whether that
Absolutely.
kills the deal or not is between buyer and seller. But it's up
True.
to me to just get everything out there and really talk about it.
Well, at the end of the day, um, if you look at it from that standpoint, that if you are able to improve your quality of earnings report, you are actually amplifying your opportunities of a good deal. You know,
Yeah,
and
we're
and
strategic advisors as well.
yeah, and then like you heard a lot of people, like you said, oh my God, I never looked at it that way. And when you're actually helping them be better,
Yeah.
you know, it all works out great in the long run. So
We're not just number crunchers, Saul. We're
yeah,
actually deal advisors. I'll give you my opinion. I'll tell you exactly what I think. And a lot of times I love it when we work with independent sponsors because
yeah,
the biggest question that independent sponsors will ask us, they're like, hey, Patrick, grade this company for me. They're not saying grade the financials, they're saying grade your experience. You know,
yeah.
Is your experience, does it feel like an A or is it an F? And so
Mm-hmm.
and I love having those conversations. I I'm doing a roofing roll up right now. I think I've
Mm-hmm.
done 8 or 10 QVs for them. Uh, and one of the targets is a pain to work with. I've called the buyer 3 times in the last 3 weeks, and I've said, I'm
Mhm.
getting paid no matter what, so I don't care what you do. But I'm
Yeah.
going to tell you exactly what I think about this company. I don't think they're your fit because,
Mm-hmm.
and I've listed the reasons why they're a pain in the butt. And I said, I just want you to know. I want you to hear my
Yeah.
experience with them. So I'm a deal
Yeah.
advisor too. I'll tell you exactly what's going on.
Yeah. Yeah. Transparency is the key, my friend. So,
Absolutely.
and at the end of the day, as an advisor, it is not just necessary for us to say the good things, but we also lay out the bad things. I mean,
Got to.
you call a spade a spade.
Got to.
All right. So, I love everything that you shared. And for anyone who is listening in who wants to connect with you, learn more about your work, or even just get a quality of earnings report done, because there's a possibility after anybody who's listened to this podcast, they might be thinking,
Yeah.
hey, let's get started. So, where's the best place for them to find you?
Easiest, LinkedIn. I'm trying
All
to
right.
post at least a couple of times a week. I like to provide information and I respond.
Mm-hmm.
Now, let me caveat that. I respond if you're asking me a sincere question, about a deal or something. If you're trying to sell me something, I probably won't respond because I get a lot of those every day and I'm just not going to respond to them. But if you're genuine and you reach out to me, I'll send you my calendar link and let's chat.
Oh yeah. Oh yeah. I mean, like people trying to sell, just tell me about it. I get that a lot as well. But yep, so I will have Patrick's LinkedIn also mentioned in the show notes, so you have
Thank
that
you.
handy. And so with that, Patrick, I want to thank you for joining us today. I think you have saved some of our listeners a lot of headaches,
Hope so.
and maybe even saved a few deals.
Yeah, I hope to
So
help.
yep, absolutely. And to everyone tuning in, remember in M&A, numbers tell a story, but only if you know how to read between the lines. So, with that, thank you everyone for tuning in. Until next time, this is Saul signing off. And until then, keep innovating in everything that you do. Cheers.
Cheers. Thank you, Saul.
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now